Happy Friday and welcome back to the Deep Dive. Today we're jumping into a platform that's really become a powerhouse in the Web3 space. We're talking about Polymarket.
It's definitely hit a new gear. I mean, our sources show it's processing over $3 billion in monthly volume.
3 billion.
Yeah. And during the 2024-2025 election cycles, it had something like 400,000 active wallets. That's not just casual interest. That's serious capital at play.
That scale is exactly why we need to look past the surface. When most people hear Polymarket, they think betting site.
Right, but the source material is very clear. For any serious financial operator, that's the wrong way to look at it.
So how should we be framing it?
We need to see it as what it is. The most liquid price discovery engine for real-world events. It's a machine for pulling together all this asymmetric information from across the globe. The price you see isn't a bet, it's the collective probability of something happening.
And that distinction from just entertainment to a real financial instrument, that's crucial. Which brings us to a mandatory point from the source notes. For everyone listening, please understand this deep dive is for informational purposes only.
Yeah.
We're studying the architecture of the platform and how the crowd prices these events. We are not, and I repeat, not recommending you go out and speculate. Any use requires extreme caution and a full awareness of the risks. We're here to study the machine, not to tell you how to drive it.
Precisely. Our mission today is to go way beyond the user interface. We're going to dissect the technical microstructure, we'll get into the actual financial derivatives being used, and we'll quantify all those hidden costs that can eat into your returns.
And most importantly, the risks, especially the risks in how these things get resolved.
That's the big one.
Okay, let's get into it, starting with the fundamentals. If we're talking like professionals, we're not dealing with bets or chips, we're dealing with financial derivatives. So what is the actual asset here?
The core asset is called a binary share, and technically it's an ERC 1155 token. Okay, it's the simplest kind of derivative contract you can imagine. Either an event happens, which is the YS share, or it doesn't, which is the NO share. The whole market is built on one really elegant mathematical rule, which is, in a perfect market, the price of a YS share plus the price of a NO share has to equal exactly $1.
Yeah.
1 USDC.
So if I'm looking at a market for, say, will candidate X win, and the price is at 65 cents.
That's the market's consensus. It's telling you there is a 65% implicit probability of that event happening based on all the capital that's been deployed.
The confidence is the asset. I like that.
It is. And the tech that makes this all work, the thing that guarantees it, is the Conditional Tokens Framework, or CTF. It was originally developed by Nasus.
Why is that framework so important?
Because it's what ensures the market is non-custodial, 100% collateralized, and always solvent. It removes the house.
So how does it do that? How does it guarantee solvency?
It all comes down to two atomic operations, split and merge. Think of the CTF as like a little mint. With the split operation, you put in 1 USDC, and it instantly mints you a complete set. 1 YES share and 1 NO share.
And merge is just the reverse, I'm guessing.
Exactly. That's the redemption part. You can always take that full set, 1 YES and 1 NO, and merge them back into your original 1 USDC. Doesn't matter what the market price is for those shares.
Ah, so that's the guarantee. Anyone holding a full set can always get their dollar back.
Precisely. That's why it's always fully collateralized. The system doesn't need a house to pay out winners from its own pocket. The money is already there.
Now, here's something that feels like it's built for a really advanced user. Negative risk, or NIG risk. This seems all about capital efficiency, especially in, complicated political races.
NIG risk is a game changer compared to old school exchanges. Imagine a primary with 10 candidates. If you want to bet no on 9 of them, you'd normally have to lock up capital 9 different times. It's incredibly inefficient.
Right, because only one of those no bets can actually win.
Exactly. And NIG risk gets that. It lets you use the same single chunk of collateral to hold no shares against multiple outcomes at the same time.
So it's like a bulk discount on risk.
That's a great way to put it. It dramatically boosts capital efficiency and makes it possible to take a position across an entire field of candidates without tying up all your funds.
Which brings us to how these trades actually happen. And the thing that shocks new users is the speed. Polymarket feels like a Web 2 site. It's instant, but it's supposed to be Web 3. So how does this hybrid central limit order book work?
It's a really clever trade-off.
Yeah.
All the heavy lifting, the order matching, managing the order book, placing limit orders, all of that happens off-chain on centralized servers.
For speed?
For instant speed.
Yeah.
And critically, for 0 gas fees per order. You're not paying every time you place or cancel an order.
But the security comes from.
The security and the final settlement always happen on-chain. They use the Polygon network for that. So you get the speed of Web 2 without sacrificing the core Web 3 principle of non-custodial ownership.
Okay, so if the matching is off-chain and I'm not paying gas, who is? How do my funds actually move on-chain when a trade goes through?
That's where the relayer service comes in. The relayer is essentially a subsidized middleman. You sign the transaction to prove you want to do it, but the relayer pays the actual Matic gas fee and pushes it to the Polygon network for you.
And where are my funds during all this?
They're non-custodial, but they sit in a proxy wallet that's created just for you. It's a Gnosis-safe instance, so think of it like your personal smart contract vault on the network. You hold the keys.
This hybrid model, it seems like it leads directly to the biggest development we found in the source material, the regulatory bifurcation. We're not talking about one Polymarket anymore, are we?
No, we're not. After all the regulatory attention back in 2022, and now with recent CFTC approval for certain markets, the entire operation had to split.
So what are the two sides?
First, you have Polymarket Global.
Mm-hmm.
This is the original permissionless version. It's available pretty much worldwide, except for sanctioned countries like, Iran, Russia, and so on. Trading there is pseudonymous.
And then there's a big one for our audience, Polymarket US.
Exactly. This is the version that's legally required for any U.S. resident. And it comes with strict know your customer or KYC rules.
So you have to submit your ID, all that stuff.
All of it. And it's subject to U.S. agency reporting. It's a completely different regulatory world.
What does that mean for the user beyond just paperwork? What's the real implication of having two separate pools?
It's deeper than just paperwork. The source material is clear that because of these legal walls, the liquidity between global and U.S. might not be fungible.
Meaning the money and the shares are in two separate buckets.
Two totally separate buckets.
Yeah.
And that opens up a fascinating possibility.
Are-
Exactly. The price for the exact same event could, in theory, be different on the U.S. platform versus the global one. A smart operator could potentially buy low on one and sell high on the other, assuming the rules allow it and the profit covers your costs.
Okay, let's talk about those costs, the frictions. Because if you're trying to figure out your actual net ROI, this is everything. What's the biggest hidden fee people just don't see?
It's the spread, without a doubt. It's the difference when you add up the price of a YES share and a NO share.
It should be $1.
It should be $1, but it's often $1.01, maybe $1.02.
Yeah.
That little extra bit, that's your immediate cost just to enter the market.
And the data on this from the sources was really eye-opening for something huge and liquid like a presidential election.
The spread is tiny, maybe 0.5% total cost, manageable.
But the danger is in the smaller markets.
Oh, it's brutal. In an illiquid niche market, the data showed a $1,000 trade could cost you up to 8%. 8%. You have to be so right just to break even at that point.
What about the explicit fees, the trading fees?
They're more nuanced. The platform really wants you to provide liquidity. So makers, people who place limit orders and wait, they pay 0 fees. They can even get rebates sometimes.
And takers, people who buy at the market price.
They usually pay 0 too in most markets. But there's a big exception.
The high-frequency crypto markets.
Yes. For those super volatile 15-minute crypto markets, the taker fee can jump to as high as 3%. It's designed specifically to discourage latency arbitrage bots and reward people providing stable liquidity.
And connecting all this back to your broader portfolio, there's the cost of opportunity.
A huge point that gets missed. Your collateral, your USDC, is just sitting there locked in a smart contract. It's not earning any yield.
Whereas if you had it in a DeFi protocol like a Fade,
You could be earning, say, 5% a year. So every dollar you have locked in a long-term Polymarket position effectively has a 5% annual cost attached to it. That adds up.
that's a perfect place to pause for a second. Let's take our mandatory break. If you're enjoying what you're hearing today, this kind of deep technical breakdown, we'd really appreciate it if you'd subscribe to the channel, leave a like, and maybe drop a comment on what you'd like us to cover next. And in the description, you're going to find 2 important links. One is to our sponsor, Broker360, and the other is a PayPal link if you'd like to support this project. Honestly, even just the cost of a coffee helps us keep making deep dives like this. Thank you so much for your support.
And we're back. We've gone through the instruments, the architecture, the hidden costs. Now we have to talk about what our sources call the single greatest risk: resolution ambiguity.
This is the nightmare scenario. This is where you can lose your money even when you were factually correct.
Because there's no human referee.
Right. It relies on a system called the optimistic oracle, which is UMA's technology. And it's built on, well, optimism. The system assumes everyone will be honest because it makes dishonesty incredibly expensive.
So walk me through it. A market closes, what happens next? Anyone can propose the result. Yes, no, or invalid. But to do that, you have to post a bond. Right now, it's about $750 in USDC.
Okay.
Once that's proposed, a 2-hour liveness period starts. This is the window for anyone else to challenge that result.
And if I disagree with the proposed outcome,
You have to put your money where your mouth is. You challenge it by posting your own matching bond, another $750. And the moment there's a challenge, everything escalates.
it goes to the main court, so to speak.
Exactly. It goes to the data verification mechanism, the DVM. And that's where all the UMA token holders vote to decide the truth. The winners get rewarded from the loser's bond.
The terrifying part here is the semantic risk. The classic case study everyone talks about is the Suitgate controversy. We have to break this one down.
It's the perfect example of the danger. It was a huge market, over $200 million, on the question, will President Zelensky wear a suit by X date? Seemed simple enough.
But it wasn't.
Not at all. The day came and photos came out of him in, a tailored jacket and trousers, but it was his usual military green attire.
So the whole thing hinged on the definition of the word suit.
Exactly. Did it mean a traditional business suit?
Yeah.
Or just any matching formal wear? Millions of dollars were hanging on how a group of UMA voters would interpret the fine print in the market's rules, the ancillary data.
So the lesson for anyone listening is crystal clear.
It has to be. You must read the rules section for every single market before you put in a dollar. Prioritize markets where the resolution source is a machine, not a human opinion.
Like official election commission data or a Bloomberg terminal feed.
Something binary, something objective. Avoid anything that depends on subjective consensus, because that's where you get into trouble.
What about when a market just fails? An event gets canceled or something?
That happens. In those edge cases, the market usually resolves in one of two ways, either 50-50, where yes and no shares both get 50 cents back, or it resolves as invalid.
An invalid means a full refund.
Oh, full refund of your capital, yeah, minus whatever you lost to spread or fees getting in.
Okay, so accepting all this complexity, how does someone go from being a user to a sophisticated operator? Give us the final checklist for security and advanced strategy.
First thing, and this is non-negotiable, financial sovereignty. If you signed up with an email using the magic link,
Which is super convenient.
it is, but you must immediately go and export your private key.
Why is that so critical?
Because if the Polymarket website ever gets shut down, if they hit the kill switch for whatever reason, that private key is the only way for you to manually interact with the smart contracts on Polygon Scan and get your money out.
Without the key, your funds are trapped.
Completely trapped. And for anyone trading serious size, the advice is simple. Connect a Web3 wallet like MetaMask and make sure that wallet is secured by a hardware wallet, a ledger, a Trezor. You want that physical sign-off for large transactions.
Let's talk about advanced strategies. We touched on arbitrage earlier.
Inter-platform arbitrage is a huge one. With the US and global markets being separate, and with other platforms like Kalshi in the mix, price differences will pop up. If you can buy at 65 cents on one and sell at 70 cents on the other, and that margin covers your fees, that's a risk-free profit.
And then there's the most powerful use case, which is actual hedging.
This is the real utility. This is where Polymarket becomes a tool for self-insurance. Say you're an investor and you're heavily exposed to the tech sector. You could buy YS shares on a geopolitical event that you think would hurt tech stocks.
So if the event happens and your portfolio tanks,
The profit from your Polymarket position acts like an insurance payout, offsetting those real-world losses. You're hedging uninsurable risk.
So to wrap it all up for our listener, what's the final 3-step checklist before committing capital?
Number 1, rules audit. Have you read the rules?
Yeah.
Is the resolution source objective and non-debatable? 2, liquidity verification. Is the order book deep enough? Can you get in and out without your own trade moving the price against you by more than 1 or 2%? That's called slippage.
And finally,
3, spread calculation. Add the USNNO price. Is this sum close to $1? If it's over, say, $1.02, the friction is probably just too high to make it worthwhile.
we've really broken down the microarchitecture, the regulatory split, the frictions, the risks. It is a powerful and obviously very complex piece of financial infrastructure.
It is. And for a final provocative thought, straight from the source material, there's very strong and ongoing speculation about a future Poly token airdrop.
Ah, A reward for early users and high-volume traders.
That's the idea. It's a powerful incentive, but it's also a trap.
How so?
The sources offer a very strong warning about this. They advise against farming volume, wash trading, just to chase a potential airdrop. The money you'll lose paying the spread and taker fees over and over will almost certainly be more than the value of some unpromised theoretical reward.
The goal has to be smart investing, not just farming for tokens.
That has to be the goal.
That's excellent advice to end on. And with that, we've reached the end of today's deep dive. We really hope you enjoyed this technical breakdown, learned something new, and that you'll join us for the next one.
Thanks for listening.
Thank you very much, and we will meet again soon. And remember, in the description of this video, you can find the PayPal link if you want to help us out. Thank you once more.